oftentimes people make more money in the second bite at the apple than they did the first bite at the apple. Welcome to the Shoot the Moon podcast, brought to you by Revenue Rocket. I'm Matt Lockhart, one of the partners here. If you're new to the podcast, Revenue Rocket is the premier growth strategist and M&A advisor to the IT services marketplace. We're the M&A people. With me today is Ryan Barnett, another partner. How are you doing, Ryan?
I am doing great, Matt. Thank you so much for being on the podcast here today. Every week we try to talk about stuff that we see in our client life and all around IT services and M&A, and got, I think, another good topic here today. Recently we just published one, whether you grow, you sell to grow, or sell in to grow, or do you buy to grow? And I think this is very similar to that of, we really want to tackle the concept of this, where growth capital meets ambition. And Matt, you're really great at setting this up, but you really came up with that concept of someone selling in to a business. And I think this is core to what we want to talk about today of, what are the trade-offs and differences between growing a company and growing a company with capital, growth capital. So why don't you start us out, just what is growth capital in the context that you're talking about, and what is that selling in type environment that people are utilizing firms like this to rapidly accelerate growth?
Absolutely. Yeah, let's back out in these terms that I think we've coined, and hopefully I think they're catching on. We start hearing them back, is selling out or selling in. Selling out is you're selling your business and you are walking away and you are transitioning that to other people, oftentimes as quickly as possible. And you're going off to retirement. You're going off to start a new venture. Oftentimes going off to do some traveling, whatever that may be. Versus selling in is you are looking to become part of a new company. And that's a term that's used by private equity a lot, or growth capital, is there's going to be a new co. It will be, you may be the platform of a new co. So at the beginning of that new company, it may look exactly, like your old company, or you could join with another firm that is backed by growth capital. And as you're a piece of a new puzzle of a new company, and you're doing that because you see an opportunity to continue to grow and continue to build additional value for your firm, your employees, and yourself. And then, growth capital simply is capital is money. And there are partners, private equity firms, family offices, additional financing firms that are looking to deploy capital, deploy funds to further their position in an area that they're looking to invest in. Most common example these days in our space is that MSP platform, and the amount of private equity and other financial firms that are in the MSP space.
I think we're seeing quite a few of these investors in the marketplace today. They are looking to partner with local operators. They're looking to really understand and tap into the skill set and the markets that IT services firms are in. And they're ultimately looking to, as you noted, put some of that capital to work. And so they're a great partner to be by your side. And it can really infuse capital and even vitality into your efforts today. So if you're selling in, it's oftentimes going to be with that other company that is investing in growth and investing kind of in your future together.
We've seen, Ryan, so many of these situations, but I think recently even more interest from, founder-led businesses that have grown their business to a point, but they recognize the difficulty in scaling beyond where they're at. And I think that maybe we've seen a little bit more of it recently, Ryan, because the climate, there's been some high headwinds for businesses and their growth. Started back to when credit, started getting tougher to find because the Silicon Valley Bank situation. And it's continued forward just because the economy has been a little bit tougher. So there's kind of been this sense of headwinds where now founders are saying, wow, in order to get to the next level, if I'm a 25 million to even $50 million organization, and I know that I can be 100 million, 150 million, $250 million, but in order to do so, I'm going to have to go make acquisitions. I'm going to have to evolve my capabilities at a faster sense, whatever it may be. But there's this point in time where more and more people are saying, hey, this is a real opportunity. And then, on the flip side to it, growth capital, private equity and the like, 10 years ago really didn't understand the value of this IT services space. But boy, 10 years later, they sure do. And there are so many firms that have built a specific, sort of focus on this tech-enabled services space that the opportunity for those two situations to come together is, well, it's exciting.
Yeah, there's not a day that goes by that we do not get a call from a private equity firm looking to make their next investment in this space. And so there's certainly the interest to deploy capital into an industry where I think a lot of the basics help. There's oftentimes recurring revenue. In downturns, companies still need IT. If you're executing on projects and you're building a good business, the cash flow is there. And I can understand why capital is coming to this space and where in the past, it was more speculative. And as we see the emergence of MSPs, CSPs, even application developers who had more managed services or maintenance related services to the code they write, investors, I think, become a little bit more knowledgeable in the space and they start to invest in the space. And when that happens, consolidation can happen that really brings sometimes a once in a lifetime opportunity for someone who's in this market. And kind of their first time at it. So Matt, when you're explaining kind of this concept to a person and they simply ask you, so how do I get started or how do I learn more? Where should someone start to think about either examples of someone who's done this really well or anything to help get someone jogged into, hey, what is this? Tell me more.
Yeah, well, I mean, I think that quite honestly, the first step is talk to us or some other advisor who's got specialty in this space, and because I think that it's a really healthy thing to do is talk to people who've been there before. If you've got partners in your peer groups that have been through this before, talk to them so that you sort of you start to contextualize it, if you will, what this means and this concept. And you'll learn, okay, what does it really mean to be a platform? What does it mean to be an add-on to an existing platform? You'll learn what does it mean to not be the sole boss anymore, right? And to work, but not also to have somebody who's, setting goals for you on a daily basis. It's an investor partner, right? And what does it mean to work through a board? What does good, growth capital look like versus, not so good growth capital? And, an example of that is there's firms that have really, a deep bench of operating partners that will help you strategize, as well as help you, think through the organizational and operational improvements that need to be made to expand and scale the firm, versus maybe not such good growth capital with that, they do things on a deal by deal basis. They really don't have expertise in a space. They heavily fund, through credit, things like this. You'll learn about, sort of this concept in the space, and the things that you need to start to sort of think about as it pertains to, really wanting to jump in. Because, when you make that decision and you jump in, and you see this more than anybody, Ryan, as the preeminent origination expert in our space, when you jump in, boy, there's a lot of people who are going to have interest in talking to you.
No, absolutely, man. It's one of those cases in which if you're an operator of an IT services firm right now, and you have you've built your business, and you're to this point where you're asking myself, do I go buy another firm? Do I maybe do a little acquisition here or there? Or do I continue my organic growth? The answer to those is probably both. Yes, if you're doing really well. It does really start to become, do you want to take on additional investment and really radically grow? And to your point, the demand has never been stronger. There is such a hunger for this market, and the opportunity for founders to really kind of, I think, do a few things. One, take some chips off the table. Like when it's your firm and you've founded this and you've bootstrapped it, which is a very common story of IT services firms, running that and being kind of responsible for everything. Yeah, you may not have a boss, but you have hundreds of bosses in your customers. So it's not quite being bossless. It's just your boss is the market, and it's like every single customer every day. And to have the opportunity to kind of grow that up and beyond, I think is something that is can be very powerful. And just coming back to my point, the buyers here are absolutely looking to invest, looking for a partner for future growth. And there certainly is kind of just financial consolidators that just want recurring revenue and want EBITDA. And what's fascinating to me is that I think business owners are kind of past just the check and just the money, and are really looking at, how do I be part of something bigger? How do I continue to fulfill my mission and what I want to do in life? And then the other thing founders I hear all the time that match up with what buyers are looking for is, it gets really tiring to wear a bunch of hats. And I think if you can wear the one hat that you're best at wearing, maybe it's sales, maybe it's marketing, maybe it's product or service delivery, maybe it's AI automation, gives you a lot of opportunities to live the life that you want as a seller to a buyer who desperately wants the services and the opportunity that you're in.
Yeah, I mean, I think that's a great point, Ryan. I mean, it can be enabling a focus. Oftentimes we'll see that with some technical sort of background founder-led businesses, and they've done a great job at scaling their business. They are, they've hired a sales leader, they've got finance functions, they've got all of these things. But what they're passionate about is sort of the technology aspects. And we see this all the time. And shoot, we had a scenario, I don't know, they were $40-50 million firm, and the founder, was running the business, had been super, super successful. He knew that when he was joining in, and in this scenario, he was selling in, but he was selling into another platform, who really wasn't that much bigger than him. But what it enabled him to do was he was able to go and create the next generation of value because of his technical expertise. He didn't need to be the CEO anymore. And he thought that was great. In other scenarios, if you are, focused and you've done a great job as a leader and you know that you've got the chops to be able to do so at a greater level of scale, and that's, you're really fired up about that opportunity, though this is a great path towards that. And we've had a ton of clients who've been in that situation where, they're continuing to lead. They've got to have their, their eyes on the pulse of all aspects of the business. They just get to do it at a greater scale faster. And, what a great opportunity there. In other scenarios, shoot, I was talking to somebody at a conference recently and it was the former founder, and now he is out, right, and working on their ongoing M&A strategy and out there meeting the next generation of partners. So, there's a ton of fun things to do. And again, you're going at a different scale. And, again, what we hear from a lot of our clients is it's sort of this re-energizing that they get. That's pretty cool.
It sounds like a second opportunity to continue and be really successful at what you want to do. But Matt, there's also that concept of literally that second bite at the apple. And I'm not sure if we did a real justice here, but would you mind just telling our audience quickly, when we say second bite at the apple, what does that mean? And ultimately, what does that mean for value creation and the opportunity that a seller, if they're going to take this path, what that means for them?
Yeah. Well, second bite of the apple is as well. That first bite at the apple is you're getting paid by, having somebody take in most cases, controlling interest of your business, right? So your business is worth $50 million and somebody is buying 60% of that business, right? So I don't have my gonculator in front of me. So, but you're getting paid $33 million out of the gate. And then you are investing, you are a partner in that new company for the remaining 40% of the enterprise value equity that you are rolling in to this new platform. And then as that platform grows, right, and grows at a faster pace than you could do so yourself, eventually that new platform sells, and that is your second bite at the apple. This isn't a outlandish statement. Oftentimes, people make more money in the second bite at the apple than they did the first bite at the apple. Right. And so there is a distinct financial opportunity by partnering up with a growth capital provider and going and running and having fun and scaling the business at a pace that you could have never done so yourself.
So, and absolutely, I think that it's perfect. So in that opportunity, that $50 million valuation you started with could increase just based on the equity that you're getting and the growth of the business. If you find the right partner, that if you're a $50 million revenue company today and you turn that into $100 million and you've got EBITDA that is approaching much just higher rates, there's also some of that that larger firms are going to have a larger payout. And so you're participating in that larger payout. And as a business owner, Matt, what if you're going to take someone on, how do you start to evaluate the platform company that's doing that? I mean, you're placing a bet with someone, and so how do you get comfortable with understanding the person you're making this bet with?
Sure. Yeah, and we've talked about this a lot. I mean, it's a get your own team together. And what I mean by that is your executive team and, what is valuable to them. Know your culture, right? Know your strategy very well. Know the goals that you want, for your organization. And then assessing the partners against all of those things, right? Yeah, obviously through the process, you need to build real trust with the people that you're working with, and trust is combination competency as well as just character and how they work. And I think that is the biggest point of being able to know that you're going to be able to maintain and or meld in culturally. Leadership principles, all of these things that are important to you and work well with a degree of flexibility, because there will be change, and there's been change in all of your businesses as you've evolved them. Um, and then what is the strategy? What is the strategy for growth? And how do you get there from if a percentage of the strategy is dependent upon continued acquisitions, how easy is it going to be able to do that with your growth partner? Do they have a committed fund? Do they have a background of doing this in the space, et cetera, et cetera? Some of those other things that we talked about. And so it would be similar. Some things are similar in terms of if for partners out there, the work that they did to assess and make sure that they were going to be good partners together. But it's, you got to look at those criterias from a cultural fit, a strategic fit, and then, obviously a financial fit.
And I think if you do this right, you really do have an opportunity for kind of fitting into the right spot. Matt, can you just help me understand, just if you're going through the same decision, what are some reasons that a founder might stop and say, I don't think this is the right path to me. And I think we hear this a lot when if someone's making a good amount of EBITDA that they're taking home today, and sometimes looking at this going, am I really getting the return I want when deals are typically have a basis in a multiple of EBITDA? Is there a decision point in which you say, should I just continue to run this business in what I'm doing compared to joining forces and hitting the gas pedal? What are some risks for this model to bring that maybe a company should just continue on their current path?
Yeah. I mean, I think there's the personal piece that we talked about a little bit earlier. Is this, something of interest to you? Going faster, working with working with partners that are, naturally that dynamic is different and exciting, but it's change. But then from a business perspective, obviously, as we just talked about, lining up with the right people, but lining up with the right plan as well. And ensuring that, there's a reasonable chance of getting there, versus being able to continue forward in a way that, is working today. If you've got a great forecast for growth, and you're like really, really confident that it's coming in, you may choose, hey, I am still interested in this opportunity, but it'd be silly for me to do something now when what we're doing is really working, and I'm growing value and I'm growing the organization at a pretty good clip. So I think that it's a combination of one part, sort of just the what are you looking to do and your own, personal goals. or if it's a partnership, your partner's goals. But then there's some timing aspect that can say, sometimes is better than others to start that process.
It's all really great food for thought here, and there's so much to consider for the opportunities for a business owner to do this. Um, with it, just the risk abatement alone is gigantic. The financial funding is really help, but the growth together is huge. The curiosity question I have here is, if you're going to go into this environment and you're selling in and you're going to be part of a kind of sell and scale kind of environment, is it mandatory that you do acquisitions from that platform? I mean, do you have to continue the acquisition growth kind of once you're under there? Do you immediately become a person whose pipeline of M&A has to expand?
Yeah, I mean, most of these growth partners recognize that the only way that you get to scale in the time frame of a typical hold period is that that there's going to be a strategy around inorganic growth. I mean, in almost all cases. Now, conversely, because we broadened out what growth capital means, if you work with a family office that can be growth capital for you, oftentimes in that scenario, they're not mandated by a typical investment hold period, and in those cases, maybe there's not as much emphasis put on inorganic growth, and it can be continue to work in a longer sort of glide path. But I think most often, Ryan, don't you think? I mean, most often we see that continued expansion will be both by improving organic growth, increasing the go-to-market capabilities, as well as being consistent with inorganic growth and acquisitions.
Yeah. It's kind of the last question I had today. Anyway, it was a little bit as much as curiosity. The reason I bring it up, if you're in that debate of should I continue to own and operate my company solely and reap the profits of that, compared to taking some chips off the table, bringing in a financial partner. If you don't have the accelerated growth from additional acquisitions, you can still grow heavily just with the investment that another capital partner and operating partner especially can help bring to the table. So even though you may think, hey, I could reap this myself, there's an opportunity to take on some of those funding partners simply to help you focus on what you should be focusing on, bring talent to the table, and bring some resources to the table to have even organic growth work in a positive way. So absolutely, I think that's a good option there. Yeah, Matt, thank you so much for the topic here today, or in the discussion. We love having these discussions with founders. I just had a great lunch with someone who was walking through some of these ideas, and it just the opportunities in IT services companies in here is just it's really they're there, and when you start to learn about them, I think there's opportunities for you to grow well beyond where you're at today, and really take some chips off the table and still do what you want to do. And to me, that's a kind of a win-win-win scenario. That's all I got for you today, Matt. Feel free to wrap it up.
Well, thank you, Ryan. A few things in wrap up. First off, a little primer, and I think that this it sort of resonates into this topic right now, is that we're going to start doing some discussions about artificial intelligence and the impact on the tech-enabled services space. And so it's a distinct point in time in which, these considerations, I think, are going to be meaningful for many people in the marketplace. That's one thing. Second thing, here in the Great White North, and I'm sure in a lot of other areas where people are listening, Last night was one of the most amazing displays of northern lights, and it's so hope you guys got out there to see that. And thanks for coming. If you've got any subjects that you'd love to talk about here on the Shoot the Moon podcast, we'd love it. Send us a note at info@revenuerocket.com, and go get it. With that, we'll tie a ribbon on it, as Mike likes to say, and we'll look forward to having Mike back next week. Thanks, everybody.